G'day, Fools. I'm Scott Phillips, the Motley Fool's Chief Investment Officer here in Australia, and welcome to our weekly series we call What I've Been Reading, where, well, we do exactly what we just said. We talk about what we've been reading, and when I say we, it's a roll call of spectacularly smart, interesting blokes, including this guy, Benny O, the Motley Fool analyst and a lead advisor. How are you, Benny?
I'm good. Good to be here. Speak to you
great
today,
to
Scott.
have you, mate. I appreciate you spending a bit of time with us and share your book you've been reading called Quality Investing by Lawrence Cunningham and a couple of others. Cunningham, of course, very well known for editing the essays of Warren Buffett and plenty more besides. But before I get into any of that and get us distracted, tell us about the book Quality Investing.
Sure thing, Scott. So I know a lot of investors that I know particularly, they tend to look for the next big growth stock or the cheapest bargains. And I have to admit, I've been guilty of this in the past. But this book, Quality Investing, it really challenges that way of thinking.
Yeah.
The authors, they argue the best investment returns come from simply owning high quality businesses for a very long time. Now, there's a question that many would ask is, what is quality? We all have an idea of quality in our daily lives. So the food we eat, the clothes we wear, the things we buy. But when you try to define quality in investing and in businesses, it's not always as obvious. It takes more of a qualitative lens, particularly to determine whether a business and its model can actually be durable over long periods of time. But the book does a really great job at defining quality, particularly for investing. And the authors, they argue that quality companies share three particular traits. Firstly, quality companies, they generate strong, predictable cash flows, but they also sustainably deliver high returns on this capital. And thirdly, there's attractive growth opportunities. On its own, you think of these financial traits, they're quite good, but when you combine them together, you get this kind of powerful compounding machine. This is where cash gets reinvested at high returns, then it just produces more cash, and then that virtuous cycle just keeps going. But you mentioned Lawrence Cunningham. I think what gives the book weight is who wrote it. So Lawrence Cunningham, he's well known, like you said, for editing the essays of Warren Buffett, which I highly recommend our members to read it. And obviously he sits on the board of Constellation Software and Markel. So they're both examples of great companies in very different industries. And then the two others, his name's Patrick Hargreaves and Torkel Ida. They come from a fund manager perspective. They're from AKO Capital, and it's a London-based equity fund that manages over $20 billion. But they have a really, really strong focus on long-term investing and actually in quality companies. But so we're getting really good insights from experienced investors. And it's not just theory, because throughout the book, they actually mention a lot of case studies that illustrate these attributes of quality investing. And they also touch on some pitfalls of quality investing and some portfolio implementation.
I like that, mate. It's funny, you talk about those characteristics, and they're kind of straightforward almost to the point of being boring. And you're right about plenty of people go, well, everyone knows that. I'm going to look over here and find an edge over here. And it tends to be a truism. It won't always necessarily be the case. Investor behavior might change. But I mean, somebody to always quote Charlie Munger and Warren Buffett, but they've been doing the basic, simple stuff for 6 decades. And everyone keeps going, they're doing really well. I'm going to do something different. And not they all have to be Warren Buffett. There's plenty of ways to skin the particular cats. But if you think about the way you just talked about the cash flow generation, the growth opportunities, and high returns on the capital, I mean, it is a really nice flywheel, right? Algebraically, not that we'll get into the maths here, but that idea of just, if you create the cash, reinvest at high rates of return, take advantage of great opportunities, by definition, that works. And so I suppose my question is twofold, mate. One, if it's also true, why is no one doing it? And two, can it really be that simple then? How much judgment is required versus using, just the black and white numbers? How do we go about finding, for our viewers, how do we go about finding these quality companies in a way that gives us the sorts of returns we're looking for?
That's a very good question, Scott, because like you said, why aren't people doing it? And I think the market, they're quite drawn to exciting stories like the turnaround story or the disruptor or breakthrough innovators. But I think one of the key lessons I took from the book was that boring is often better, like you mentioned. Yes, we can find companies in those kind of high growth categories, but many quality companies, they're not very flashy. They're just simple businesses with enduring traits. Think of like recurring revenue. They got sticky products. They're resilient through downturns and through the cycle. So I think the book they mentioned a good example was there's a Finnish elevator company called Kone.
Yeah.
It sells elevators. Doesn't sound exciting at all, but every sale of elevator, it creates a steady, predictable cash flows from those maintenance contracts, and it's over decades, right? So, and they continually generate high returns on that, and then the growth continues to grow because it's tied to urbanization. So, I think, like, to answer your question, people probably just are focused on the wrong areas. And I think this book really harps on and really focuses on what the importance is in investing, in particular quality investing. And I think one part of that is part of the equation is that quality isn't just science, it's also art. So you mentioned all these numerical and algebraical math equations and stuff. That's the science. That's the things like cash flow, return on capital, growth rates. But the art is actually in judging the kind of harder to measure traits. I like to think of like culture, management, a particular company's brand strength, and particularly how durable these trait moats can actually to be over time. And I think these things are much harder to replicate, and also things that you don't see in financial statements. So that's probably one of the other key lessons I'll probably point to. And probably the last one is probably around investors needing to stay patient. I think the discipline to stay patient, right? So companies with quality traits, they tend to have a high probability of succeeding over time. But once you've found them, the hardest part isn't the buying. It's actually having the patience to hold on. Like I mentioned before, the market constantly tempts us to trade in and out. But when you invest in high quality companies, the best results usually come from doing less, not more. And I think you speak to this a lot within our own investing team. And it typically that means holding and doing nothing, and letting time do the compounding for you. So you may sound boring in the short run, but over the long run, it can be really, really powerful. So I think those are the kind of key lessons I'll probably point to, and just to answer your questions as well.
Love it, Benny. I think, waiting is boring. Making money, not so boring. It depends on where you want to put your focus, right? If we focus on the right things, you can put up a lot of short-term boredom if it means the long-term is a little more exciting with a few more dollars to spend. Mate, just to finish off, was there anything particularly that surprised you or that you took out of this book? Anything you're going to put into play with your own investing, either from scratch or in a newly revised or kind of focused way?
I think the thing that surprised me was obviously the key lessons I just mentioned. Boring is often better. So like I said, I'm guilty of looking for those high growth, hyper growth companies. But if you kind of look at the ones that are steady growers, they can probably be better performers in your portfolio over the longer time period. A lot of the kind of insights they provided isn't always groundbreaking, but it's really great to hear it from these experienced investors who've gone through the trenches. They've got this well experienced. So it's a great book. Heaps of insights, and I mentioned it before that they even talk about the signals, the false signals of quality. So people have picked up things that they thought was quality companies, but they might have just been benefiting from temporary trends. I think one at the moment is I'm not sure if you heard of those dolls, those fancy, weird looking dolls named Labubus.
Yeah.
Exactly.
I know. I couldn't recognize one on the shelf, but I've heard the word. So there you go.
Yeah. Well, it's blowing up, and the company that's making them, their stock price is rallying rapidly. Right. So, is this a sustainable trend? I'm not sure. It could be a fad, but it's like the next Hello Kitty potentially.
Yes,
But essentially, those are the things that the book kind of touched on from the first principle thinking. And I think there's things that can be implemented in practice as well. So I have a lot to take away. I've added to my list of favorite investing books, and I'll probably definitely read it sometime again.
Nice. That's high praise indeed. Benny O, thank you for sharing your thoughts and the book Quality Investing. Phil's just below this video in the bio. We'll actually put a link to it on Amazon, probably, I assume. Just if you want to grab a copy of it, think about it, because Benny makes a pretty compelling case. And sometimes it's not the new things you learn, it's the old things that you're reminded of that can make all the difference. Thanks for watching. Thanks for being with us. Before you go, by the way, usual stuff, right? Like the video if you do. Like what Benny's had to say, I'm sure you have and will and do, so please do that for me. Also, if you want to see more stuff from us, Stocks in Focus, Stock of the Month, what I've been reading, Motley Fool TV. I'm going to do a YouTube Q&A live soon, so you don't want to miss that one. I'm not sure when it'll be yet, but it'll be sometime soon, so make sure you do subscribe to the channel, hit the notification bell. That way, when we do put something up, it'll simply send you an alert. If you don't want it, don't do it. But if you are liking what we're doing, if you're at this point in the video, you probably want to see more. more from us, and that's the best way to make sure you don't miss out. All right. Thanks for watching. Thanks for being with us. Until next time, Fool on.